Welcome back, investors, to Ticker Time News. I'm Adam, and Tuesday was yet another roller coaster ride driven by major macro headlines that brought many key levels across many assets into play. The day started with a positive inflation data surprise as the October Producer Price Index for final demand increased 0.2% month over month. The expectation was a positive 0.5%. Core PPI, excluding food and energy, was unchanged month over month. The expectation was a positive 0.4%. The monthly changes left the Producer Price Index up 8% year over year versus 8.4% in September. And core PPI, excluding food and energy, of course, was up 6.7% year over year versus 7.1% in September. The key takeaway here is the clear signs of disinflation embedded in it. Like the CPI report, inflation is still too high at the producer level, yet the direction is more important to investors or market participants right now than the actual level that the PPI and the CPI are printing. The lower trend in PPI and, of course, CPI is another nudge in the direction of the peak inflation narrative, which ultimately will help fuel speculation about a less aggressive Fed moving forward. The results of the PPI, the result of the PPI report this morning was a big pop higher in equity futures. The S&P 500, it ran all the way up to 4050. Just 27 points shy of its 200-day moving average, but it could not hold that 4,000 line into the close. The dollar, it took a sharp hit too. Let me pull the dollar up here on the chart first. I probably should have started with this, but it took a big hit. The euro was up to test its 200-day moving average against the dollar. And then, of course, we had the yields move as well today, but not quite as a run to safety from the Ukraine-Poland news. But look here at the 10-year. A big wick on the bottom of today's candle on the 10-year. This could be leading to something right here. All right, big wick on the bottom. The wick itself for the 10-year yield actually came down and tested its support level, which is in this blue box right down here. Underneath the wick. So it found support there and it bounced and it ran back up. So this was a very active market today. Let me get those two out there. If we look, so what we have got right here is this down channel that we've been in. And now we get hit with this candle right here that's got this body on it like this. All right. And then it's got this little wick underneath of it. That's not a very good representation. How about this? It's got a big body up top, long wick underneath it. If we pull up our candlestick patterns, where do we see that? Where do we see a downtrend and a long wick underneath? Well, let me take a couple things off from yesterday. And right here, the dragonfly top. This can signal right here that a bottom is in, and this could be a bullish move. So look at this. We have a downtrend, and then we have a candle that's got a smaller wick at the top, followed by a big long wick underneath that candle. This is a reversal candle, okay? This is the dragonfly doji. Now, let's go back and look. Do we have this same kind of setup? Big downtrend, leading to a candle, big wick on the bottom of the candle, smaller candle at the top, not much of a body there. This could potentially be the dragonfly doji, where we are in a downtrend. We have found support for the 10-year yield, and now we are going to bounce and come back up. That is the potential play I see setting up for the 10-year. Based off of the technical analysis here. Same thing that I'm showing you on the chart. That's exactly what I see happening right now. Now, if we go back just a couple of weeks, right, and look at the candle formation the last time we got to a point where we had fallen off, right? We had a green candle, but the very next day, we had that giant fall, which was last Thursday, which was a big move in equities off of CPI print, right? Okay, so we don't have that same dragonfly doji setup there that we have now. If we go back the last time we had a reversal, nope, we didn't have that dragonfly doji at all. And the time before it, nope, no dragonfly doji there either. So this to me is looking pretty good for a reversal. Now, going back here, look over here. This is back in September. We do have a drop down to a potential dragonfly doji here, but I don't think the body compared to the wick of the candle was the right ratio for that. But that did in turn count as a reversal, and we had a giant green day before moving sideways. So keep that in mind. The 10-year could be setting up here. My apologies. I'm saying the 10-year. Holy moly, I'm lost. The dollar. Let me tighten this up. So the dollar has the dragonfly doji potential setup here, which would be bullish for a type of reversal off of where we are right now. So keep that in mind for the dollar. Now, when the dollar does move with a big rate of change, what happens to the S&P 500, to the SPY, to the Qs? They go down. So we have to pay attention to all the moving parts here. The dollar is step one. Then if we look at the 10-year yield, let's pull the 10-year yield up here. The 10-year yield, it fell to a 6-week low of 3.76%, exactly where it sits right now. It hasn't moved at all. Now, this point, okay, it broke below and it closed below its 50-day moving average. That's significant, right? Because with the 50-day moving average, it is bullish above, bearish below. So keep that in mind. We do have that. Now, as far as a candle setup, I'm not really seeing one, okay? Let's pull the candlesticks up, right? Nothing. So to me, this is pretty neutral. It could continue down. Its support level, if it continues to fall, is all the way down here, starting at about 3.65%. So the 10-year would have a little ways to fall if it did continue to move down like that. Now, back to the dollar. The dollar could pivot at the point where it's at right now, pulling down the SPX, S&P 500, and the SPY. But if the 10-year continues to pull down, that actually could be good news for the Qs. And we kind of saw that with the makeup of how the SPY and Qs moved today. The SPY was up 0.9%, and the Qs were up 1.4%. So a pretty big difference between the two in how they moved today. But we'll get back to talking about them in just a moment. Now, this was just a warm-up for today. There was some morning chop, right? Let me go to the SPX, and I'm going to go to the 5-minute chart, and we'll take a look at this to see what could potentially be in the mix here moving forward. We're at key levels right now. All the levels that I talked about yesterday are still in play today. All of them. All right, let's pull this up, make it a little bigger. Now, one key, very key development here for today. Now, the majority of the candles you see are today for the 5-minute chart. Of course, above my head, we've got the decline going into yesterday's close. But from down here at yesterday's close, you can see the big gap up all the way up here this morning. Big gap up. Oh, now the chart wants to play with me. It was set up so nice. All right, let's readjust this chart. All right, when this chart gets back into focus here, I want you to pay attention to where the market closed yesterday and today's low. Okay. All right. Yesterday's close. Let me get my highlighter back. And today's low. Is there a similarity there? Absolutely. They're identical. Yesterday's closing low was today's low in the market. When the news came out about Ukraine, that's when the market fell early afternoon. And it found support at around the 39.55, about where we closed yesterday. All right. So that is interesting. And of course, that news that caused the market to really drop off a cliff there was a potential Russian missile striking Poland. And obviously, that's not a good sign. In theory, that could represent a viable pretext to NATO forces going into direct combat operations with Russia, something, of course, we don't want to see. And if that is the course of action that is decided to be taken, that won't be good for the market. Now, the facts on the ground in the Russia, Ukraine, Poland situation, they're a bit uncertain, and it'll take a little bit of time to sort out. I'm sure there's all kinds of headlines out there saying this thing or that, Article 5, blah, blah, blah. Keep an open mind. Read your news sources that you find credible, because it will affect this market very quickly. Now, stocks spent the rest of the afternoon, as you can see, chopping back to the upside, where they closed well below levels seen in the wake of the PPI print. Okay. PPI print, we jumped all the way up to here, but we close down here. And the red line running across here, notice this afternoon what happened on this red line. That's the 4,000 mark. The S&P could not get back above the 4,000 level after this news about Russia, Ukraine, Poland came out. Could not find the momentum to get back above it. Now, what do we have tomorrow that could give us momentum to jump like the producer price index? We've got the retail report. Do you think that's going to have enough momentum to send the S&P back above the 4,000 level? I don't think it's going to have that much momentum. Now, other factors at work in today's stock market that favored the market, we had a good earnings report from Walmart. Walmart jumped 6.5%. We had Bank of America Fund Manager Survey, which again shows an elevated cash position of 6.2%, which is higher than it was during the great financial crisis back in 2008 and the 2020 pandemic panic in March of 2020, stirring up contrarian buying interest. But it's just not enough momentum. Now, a quick little side note here about the 10-year and how it worked into this market. With the news out of Russia, Ukraine, Poland, the falling treasury yields and the weakening dollar, it didn't have the same impact of a flee to safety off of a big news event. So have we seen if what is happening in Europe has that affect the market yet? I mean, sure, we had this dip in the middle of the day. We climbed back halfway. I don't know that did it really play that big of a role in the market when the 10-year was down ultimately, when the dollar was down ultimately. Just some things to consider. Now, mega cap stocks were integral today in the index level gains that we saw and the recovery effort, I guess I should say, off of the session lows. The Vanguard Mega Cap Growth ETF, ticker symbol MGK, it was up 1.3% versus the 0.9% gain in the S&P 500. 9 of the 11 S&P 500 sectors closed in positive territory. We had healthcare and materials, both down 0.1%. Healthcare, more of a defensive sector. Now, they set alone at the bottom of the leaderboard. Now, communication services, XLC, was up 1.8%. Information technology, XLK, was also up, but up 1.2%. They were atop the leaderboard. Now, the communication services sector, it had its gains boosted by a big gain in Paramount, ticker symbol PARA. Paramount was up 5.1% after Berkshire Hathaway, which is Warren Buffett's company, disclosed an increased position in the company in its 13F filing. And there's another surprise in that filing we'll talk about in just a quick moment. How's it going? Hello? Alphabet up 2.8%. Netflix up 3.7%. Also helped sector gains. Now, Netflix actually received, and we were kind of talking about these upgrade downgrades yesterday. Now, Netflix got a double upgrade to a buy from underperform at Bank of America Securities. Interesting, huh? Then the information technology sector was bolstered by strong gains in semiconductor components. And here's that other Warren Buffett piece of news. Taiwan Semi, ticker symbol TSM, up 10.5%. It was a winning standout for the group after Berkshire Hathaway disclosed a new position of about 60 million shares in a 13F filing. The Van Erik Semiconductor ETF was up 3.1% today. Big day for semiconductors. Now, energy component futures settled the session higher. Crude oil was up 1% to $86.69 a barrel. Then, ahead of the close for tomorrow, or ahead of the open for tomorrow, we've got Target, Lowe's, TJ Maxx, retailers, all headlining with their earnings report. Now, there's a slew of economic data that's coming out tomorrow. The biggest one will be the retail sales report. The expectation is 0.9%, and the prior reading was 0%. And then retail sales take out automotive sales. The expectation is 0.6%. The prior reading was 0.1%. That's the biggest report that comes out tomorrow. There's a bunch of other little ones. We can talk about them if they have a bit of an impact or not, but we'll save those for tomorrow if we need be. Now, for the housing market, there is a report that I have to point out that comes out tomorrow. It's the November NAHB Housing Market Index. The expectation is 36. The prior reading was 38. The housing market is a big old bubble just waiting to come down and collapse. So watch out for that housing market data. All right, let's go index by index, major index product here, and talk about the key levels like we did yesterday, because they are all in play. Every single level mentioned yesterday is still in play. But puts today, as per instruction, took a little profit. That's good. That's good. I'm sure this afternoon downfall helped with that. All right, let's go to the daily view here on the chart, and let's look at these index products. And I should have done this first. All right, let me fix this chart real quick. Put that up so everyone can see. All right, I'm going to open this up. I got to take those highlighter marks off. Just give me about 20 seconds or less to get this chart looking right. So again, if you did watch yesterday, I'm going to kind of repeat a few things that I said yesterday, because they are still in play today. Not a whole lot changed when it comes to the levels, the key levels here. So starting with the SPX for the S&P 500. It got closed down at that 4,000 level today. To me, this looks to be a good time to start small with puts, all right, or shorting the SPX. Why? We're a bit long in the tooth here. And if this rally does continue, if there can be some sort of momentum, that pushes us above the 4,000 level. This 4,100 is going to be a key level to keep this rally from going any further. The 200-day moving average is also going in this direction here. The 200-day moving average is about 40.75 right now. As a matter of fact, it's 40.76 to the point there. So we have this level, this zone between 40.76 to 41.15 that will put this rally in its place and stop it. If, and it's still a big if this rally can go that high. 4,000 is proving to be very, very tough. And what momentum do we have left in this week? I guess if retail sales are strong tomorrow and, the retail companies, Lowe's, TJ Maxx, Target, if they have good earnings, sure, then maybe that could give a little momentum to the retail sector of the market. But I wouldn't be so sure on that. Okay? So that level is definitely going to be strong resistance. I mean, 4,000 is proving to be really, really tough. Now, we are still disconnected from our 5-day EMA, our 5-day moving average. 3 days is really unheard of. Only one time between now and going back to the middle of August on the chart here, were we separated from the 5-day EMA for 3 days. Day number 4, we reconnected with it. So this is only the second time since August that we've been disconnected from that 5-day moving average for 3 days. Right now, that 5-day moving average is sitting at 39.39 right here. 39.39 is where it's sitting at. Now, when the SPX fell this afternoon, it came close to reconnecting with it, but it didn't. The lows of today were 39.53. 39.39 is where that 5-day EMA sits at. So, to me, obviously, there's no guarantees, but we've got to reconnect with it, okay? Whether that happens tomorrow or what, 3 days is an extremely long time to be disconnected from it. So we've got that. Now, other magic working the 4,000 level is the 61.8% Fibonacci level. It's sitting at 4,008. That's also putting a lid on any rally going above that level. So we've got some major things here. We've got the Fibonacci pushing it down. We've got the 4,000 level pushing it down. And we've got the 5-day moving average pulling it down. So there's a lot of resistance right here where it is right now. And it just can't seem to catch a break to move any higher. Now, that's probably going to be the playbook for the majority of November. It's going to be a market that chops around, washes people out, and moves sideways before we can get into a Santa Claus rally. Maybe we even head the other way, down slightly. Because remember, on the, let's put it up right here on the screen. On the S&P 500 midterm election year seasonality pattern going back to 1946, the month of November, from here to here, this month, we trend down in a very choppy fashion before reaching the end of November, the beginning of December, and then we start to rally into the end of the year. Now, I do find it interesting that we end the year lower than when we started the year. And it's the red line that we're paying attention to, okay? So we do have some forces pushing the S&P down right now and will continue to do so throughout the month of November. December, on the other hand, could be an interesting month for a rally. But moving sideways and moving down is definitely the direction that I think we're going in for the month of November. And that chart, it has worked out to being pretty spot on all year. It's called all the major bottoms. All right, let's go to the SPY, look at the key levels. Again, they are very similar to yesterday. Let the lines load here. Okay, so 400. That's the magic number here for the SPY. The SPY can't get above it to save its life. 400 is strong resistance, just like the SPX. The SPY has 400 as a resistance area. 400 is the 61.8% Fibonacci level. So we got two forces keeping the SPY down. And then we have the 5-day EMA, which is at 393. We closed at 398. Again, 3 days disconnected from that 5-day moving average. That is not typical. We typically stay connected to it like a circuit, right? Okay, so those are three forces working against the SPY on the chart here. Now, if it does break down, then watch for the lower end of the weekly expected move to find support, which is right around 388, okay? And then 390 is the 50% retracement level for the SPY. So you'll have 390 and 388 as two sources that could potentially be a nice level of support if this thing comes back down. And with 390, 388 being support levels, then that supports the theory of November moving sideways and not being a very fun month for whether you're going long or whether you're going short. It's going to make the month very difficult to trade. That's a possibility for this month. All right, so now on the upper side, if we do break 400, where should we watch for? Well, we've got a very strong resistance coming down like this red line here. And the more time it takes, the further down this line is going to be. So if we just look at Friday of this week, which is the 18th, and look at where that red line is, that's about 409. 409. And remember, on the SPX, the Fibonacci level is at 4008. So some confluence here between the two. Of course, they're both based on the S&P 500. So 400, tough resistance. If it does break through, maybe it's going to 409, and that will be it. Okay? That'll be it. We also have the 200-day moving average, which is at 406 right now. That's going to be a headwind. And the upper end of the weekly expected move is also at 408. So, again, a lot of headwinds once or if the SPY wants to break above 400. Getting to 409 is going to be, getting above 409 is going to be tough. Okay? Going to be real tough. All right. If it decides to break down, move sideways, we have the 50% retracement level at 390 and 388. That's where support could come in. So again, if we drop from 400, then we're going down to 390, 388 for the SPY. Let's go look at the Qs next. And again, a lot of these points, these key levels are very similar to yesterday. Only a handful of them have even moved since yesterday. Here, we've got the Qs disconnected from the 5-day EMA. it's not very frequent that we stay disconnected for 3 days like this. So we're going to reconnect with that sometime and sometime soon. And it's at 283 is where that 5-day EMA is. 283. We closed at 289 today. Now, up top, let our lines come back in that we set up. They should be loading. There we go. Up top, we've got the 50% retracement. It's at 294. And then we've got the upper end of the weekly expected move at 297. So look between there, 294 to 297 as a place that will act as resistance for the Qs. And it almost got up to the 50% retracement today, but did not quite get there again. And that's at 294. Didn't quite get there. Now, underneath it, remember yesterday we said something interesting about the Qs is it is sitting on this potential support area. And there's this trend line support that caught this top and this top as resistance, but yesterday it found support there. And the 38.2% retracement level is also right there at the 284. So that is a very interesting place that maybe the Qs found a little support at, okay? And that may keep them from slipping as much as the SPX or the SPY does. So there may be some more upside room for the Qs. And with technology being beaten down as much as it has, I would expect that. All right. So on the on the upper end, if it continues to go, it'll find resistance between 297 and 294. And on the lower end, it's finding support at 284 to 285. But if it breaks that and wants to come back down, the weekly expected move is at 278. And then the next fib level below that is 273. And there's a lot of confluence there with anchored VWAPs from major events all right here too. So there'll be plenty of support if it gets down that far. And this little bit of movement that it could be making, either up or down, there are pretty stiff resistance and support levels there, keeping this range bound. And that's what it looks like November is going to be, a range bound month. Now, if we look at the Dow Jones, we said yesterday that if anything was looking like a good thing to short, it would be the Dow Jones and the ticker symbol DIA. Well, it was up 0.13% today. It has got stiff resistance overhead, okay? It has let me pull this together a little bit here for you. So it has the mid-August high right here. And that high is 343. 343. If it breaks that, that would be significant. Unfortunately, there's a lot of resistance here at this point. The upper end of the weekly expected move is at 345. I don't think it's going to go there. I don't think it's going to make that. And it's just too much resistance up here. We also have a resistance point here at 340, and that's more in line with what's keeping this thing cut off. Now, underneath of it, it did reconnect with its 5-day EMA today. That's important. That 5-day EMA was at 334. So that's a good thing for the Dow to keep it elevated up here. But it's just been running like crazy. And why? Why has the Dow Jones been running like this? The DIA as the ticker symbol. Because of earnings. Earnings from big components within the Dow Jones, and their earnings were outperforming relative to the rest of the market. That's why the Dow Jones has been performing so well during the month of October, especially the back half of October. But I think that's over with. I think that's over with. And I think the only thing for the Dow to do now is to slowly sink lower. So again, something that's no guarantees in the market, but something that looks good to short, if you're into shorting, is ticker DIA. But again, nothing is guaranteed, not professional advice, not financial advice. Do your own research and see if you find these things to be true as well. And then you can move on them. Now, on the downside here, we do have the lower end of the weekly expected move at 330. And 331 is a Fibonacci level. So both of those could act as a little bit of support. We had some resistance there before. We had some support there before, resistance before. So that 330 is a very active, very sticky number for the Dow Jones, ticker symbol DIA. Okay, let's go look at the IWM, and then we'll wrap this one up for tonight. All right. While this is loading, one thing to note on crypto, with all of the problems with the exchanges, FTX going down, BlockFi going down, all the ones that came before it that have crashed and burned, your keys, your crypto really means something. And learning to hold your crypto on your own keys, with your own keys, I should say, seems to be the much smarter move, and it's the lesson to take away from the FTX crash and the other crashes that have come before it. Don't leave your crypto on these exchanges. Don't leave them on the exchanges. If you're just buying it and holding it, use your own device, take it off these exchanges, and you hold it yourself. It is much safer that way. It can never be blocked from you accessing it. It is yours. So take that and use it with what you will. Okay, now with the IWM, this is your small caps. Now we had a major trend line coming down here just like this. We also had the 200-day moving average matching right up with that. It was running just like this. So if we look at how the candles acted to this, if we go back to last Friday, we had a little momentum to push us above the 200-day moving average, but not to close above that trend line. And then yesterday, Monday, we closed under that 200-day moving average. Now today, we get this nice gap up, and it takes us above the 200-day moving average and above the trend line resistance, the downsloping trend line resistance, and it leaves us with a doji candle. What's a doji candle? Let's go over here to the candlestick chart. And this is a doji candle right here. What I'm looking at is this right here. Very small candle in the middle of two decent size wicks there. Okay, that's neutral. That means this thing could go in any direction. Okay, so let's put this back down. So we've got a neutral candle forming. All right, and we are into some pretty stiff resistance here at this level of 190. When we tried to rally right here, we were rejected at 190. All right, we can back up. When we were rallying right here, we got rejected at 190 before gapping up and moving through. But that only created this island topping pattern right here for the IWM. And then we came and sold off like crazy. So here we've kind of chopped around, right? And then we went for a rally, got rejected, pulled back, and we went on a massive move up. What I'm seeing here is we have run out of steam for the IWM. It's hit some resistance. Now, one thing that I will also point out is this morning when it did jump up above the 200-day moving average, downsloping, I must add, a downsloping trend line, it did pop up above the 61.8% Fibonacci retracement level. Okay, so there are three things right here that should be keeping the IWM from going any higher, all in the same place. Okay, all right here. So what I'm thinking is the IWM, it's gone as far as it can. Okay, and if you're looking for something to short, the DIA looks more promising. Okay, it's got more reasons to be in a shorting mood right now than small caps. Because one thing that you have to be careful with small caps can really easily outperform the broader market due to short squeezes. And that's something that you'll always have to be cautious with on the IWM. It can move up real quick. It can move down real quick because of those. So do be careful here. This is a very tricky place for the IWM. There's a lot of reasons to keep it down, to keep it from going any higher. Can it outdo those resistance points right there? Maybe. I wouldn't lean towards it could happen, but anything is possible. I think the safer bet is with the DIA. Shorting the Dow Jones looks to be the better possible setup out of the main indices. And then, of course, finding setups within the individual stocks that make up those indices is another good idea. Okay. All right. Now I have wrapped up everything I wanted to say. If you do have any questions, please feel free to leave them in the comment section. We will be glad to go over them. Otherwise, I will wrap this up. I'll give you a couple minutes to put in a question if you have them. Otherwise, if you could do me a favor and click that like button, share this video with a friend, and if you like the perspective, click the first link in the description. We've got weekly momentum stocks, weekly expected moves, a whole bunch of information that I think would help you to become a better investor and a better trader. So click the first link in the description if you find that interesting. If not, just click that like button, share this video. Those are two wonderful things that you can do to help out and support this channel. All right, well, we will wrap it up for tonight. I greatly appreciate each and every one of you for spending your time with me and joining me here along this journey. And I'll be back tomorrow after the market is closed to talk about what happened, why it happened, and what to expect moving forward. Okay, ladies and gentlemen, have a wonderful evening, and I'll see you in the next video. Take care.